the strategy everyone mocked until it worked. It started as a punchline, a strategy so unconventional that professionals laughed out of conference rooms and dismissed it in private notes. Yet years later, that same idea would outperform the very models that mocked it. To understand why this matters, we need to return to a time when the market agreed on almost everything. Risk was defined the same way everywhere. Portfolios were built from the same assumptions. Innovation existed, but only inside narrow boundaries approved by history and precedent. Anything outside those boundaries wasn't debated. It was ridiculed. This story matters now because markets punish originality before they reward it. The strategies that survive ridicule often do so because they challenge assumptions everyone else depends on. And the one at the center of this story didn't fail early because it was wrong. It failed early because it didn't fit. The first reveal begins with its creator, a quiet researcher who wasn't trying to disrupt anything. He was responding to frustration. Traditional strategies performed well during stable periods, but broke down under stress. Diversification vanished when it was needed most. Hedging costs exploded at the worst possible moments. Instead of optimizing returns, he focused on something unfashionable, robustness. He designed a strategy that intentionally underperformed in calm markets. It avoided crowded trades. It limited leverage. It sacrificed short-term gains to preserve flexibility. On paper, it looked inefficient. Compared to peers chasing benchmarks, it looked slow, conservative, even naive. And that was enough for most institutions to ignore it. The second reveal came during early testing. The strategy behaved differently from expectations. It didn't shine when volatility was low. It didn't impress during rallies. But during brief stress events, minor shocks that barely registered in headlines, it held its ground. Losses were contained. Recovery was fast. Where others stumbled, it absorbed impact quietly. The third reveal emerged when critics analyzed it and drew the wrong conclusion. They saw underperformance and called it failure. They compared returns without considering conditions. They evaluated it through the same lens it was designed to challenge. And in doing so, they missed the point entirely. The strategy wasn't built to win popularity contests. It was built to survive the moments everyone else ignored. And that difference would soon matter more than anyone expected. As time passed, the strategy remained an outlier. Quarterly reviews showed it lagging peers during bull runs. Performance charts looked uninspiring. Committees questioned why capital was tied up in something that refused to keep pace with the market's enthusiasm. Some early adopters abandoned it, chasing higher returns elsewhere. To most observers, the mockery felt justified. But beneath the surface, something important was happening. The strategy's internal structure was adapting quietly. It rebalanced automatically as markets shifted. It reduced exposure when correlations tightened. It preserved liquidity, while others spent it freely. These adjustments weren't dramatic enough to show up in marketing decks, but they mattered deeply when conditions changed. The conflict emerged when the market entered a prolonged period of artificial calm. Volatility stayed low. Credit remained easy. Risk premiums compressed across assets. Traditional strategies flourished, feeding on leverage and momentum. In comparison, the mock strategy looked increasingly obsolete. Critics use it as an example of overthinking, proof that simplicity and scale always won. Yet the creator noticed something unsettling. As traditional strategies converged, their behavior became more synchronized. Different portfolios began reacting the same way to small market movements. Hedging assumptions weakened. Liquidity demands aligned. The system was becoming efficient on the surface and brittle underneath. He ran stress scenarios that most firms avoided. Not extreme crashes, but moderate disruptions, rate surprises, correlation breaks, funding hiccups. In these simulations, the strategy that everyone mocked behaved differently. It didn't need perfect liquidity. It didn't rely on continuous pricing. It absorbed shocks by design because it had never optimized for smoothness in the first place. The tension grew when a few institutions quietly revisited the data. They noticed that during every minor disruption, events the market barely remembered, the strategy lost less and recovered faster. Its edge wasn't explosive. It was cumulative. Over time, It preserved capital while others leaked it away during stress. Still, convincing decision-makers proved nearly impossible. The strategy violated the culture of performance measurement. It demanded patience in a world addicted to quarterly rankings. It required accepting visible underperformance in exchange for invisible protection. And invisible benefits rarely survive budget meetings. As markets continued rising, the ridicule intensified. Commentators cited the strategy as a cautionary tale about ignoring momentum. Investors demanded exposure to what was working now, not what might work later. The creator watched as capital flowed into increasingly crowded positions, all justified by models assuming stability would persist. He didn't argue publicly. He simply waited, because the strategy wasn't designed for applause. It was designed for the moment when stability finally broke. And that moment, though unseen, was drawing closer with every synchronized move the market made. The break came not as a dramatic collapse, but as a sequence of small failures that fed on each other. A funding market tightened unexpectedly. A routine auction cleared at worse terms than anticipated. A policy statement introduced uncertainty where confidence had been assumed. Individually, none of these events mattered. Together, they changed the market's behavior overnight. Traditional strategies reacted exactly as they were built to react. They reduced exposure simultaneously. They sold the same assets at the same time. Liquidity that once seemed abundant vanished as everyone reached for the exit together. Prices gapped. Correlation spiked. Diversification disappeared in real time. The mock strategy behaved differently. It didn't rush to unwind. It did require immediate liquidity. It had already reduced exposure quietly as conditions became fragile. Where others needed perfect execution, it needed patience. Where others were forced to act, it was free to wait. The conflict reached its peak as losses mounted across portfolios once considered resilient. Strategies that had dominated leaderboards for years suddenly faced drawdowns they weren't designed to handle. Risk models flashed warnings too late to matter. Hedging costs exploded precisely when protection was most needed. Confidence, built slowly over years, unraveled in days. Inside review meetings, attention shifted abruptly. The strategy no one wanted to discuss was now the only one holding its ground, not outperforming dramatically, but surviving intact. While others scrambled to explain losses, its results spoke quietly for themselves. The creator watched the change in tone unfold. Questions replaced laughter. Requests replaced ridicule. Executives who once dismissed the approach now asked for detailed breakdowns. How did it avoid foreselling? Why didn't it rely on continuous liquidity? What assumptions did it reject that others depended on? He explained simply that the strategy accepted mediocrity in calm markets to avoid catastrophe in unstable ones. It traded elegance for resilience, popularity for robustness, and in doing so, it aligned with a truth markets rarely acknowledge. Smooth performance often masks fragile structure. The build-up intensified as the market attempted to recover. Volatility stayed elevated. Liquidity remained uneven. Many traditional strategies struggled to regain footing. Their losses weren't fatal, but they were permanent. Capital loss during stress is hard to replace. The mock strategy recovered quietly, steadily, without urgency. It didn't need to chase rebounds. It let dislocations resolve on their own terms. And over the full cycle, calm, stress recovery, it delivered something few others could: consistency. In that moment, the narrative inverted. What had looked inefficient was revealed as adaptive. What had looked conservative was revealed as prepared. And what had been mocked for years had just proven it understood the market better than the strategies built to impress it. The only question left was whether the industry was ready to accept the lesson, or whether it would forget it again as soon as conditions felt comfortable. The acceptance came slowly and unevenly. Some institutions embraced the lesson immediately, reallocating capital towards strategies designed for endurance rather than spectacle. Others hesitated, uncomfortable with the idea that years of optimization had produced fragility instead of strength. Admitting the strategy worked meant admitting that the industry's definition of success had been incomplete. The climax wasn't a headline or a declaration. It was a shift in behavior. Committees stopped asking why the strategy underperformed in rallies and started asking how it survived stress so effectively. Performance reviews expanded beyond returns to include drawdowns, recovery time, and liquidity dependence. Quietly, the framework of evaluation began to change. The creator didn't celebrate the vindication. He understood something most people didn't. Markets have short memories. The same forces that mocked his work will return the moment conditions felt safe again. So instead of chasing recognition, he documented the principles behind the strategy, why it worked, when it worked, and what assumptions it refused to make. The resolution settled in as portfolios stabilized and the market found its footing. Losses elsewhere were locked in. Capital had been permanently reshaped by a moment of fragility few anticipated. And in that aftermath, the once mocked strategy stood as proof that success isn't always about winning the race. Sometimes it's about not breaking when the track collapses. The deeper lesson echoed beyond this single approach. Markets don't reward intelligence alone. They reward alignment with reality. And reality is rarely smooth, rarely continuous, and never obligated to behave the way models expect. Strategies built to impress thrive when conditions are ideal. Strategies built to endure thrive when they're not. So what do you think? Are we still mocking the ideas that will save us in the next crisis again?